Hi everyone, this is Rob Roy and welcome to the Elliott Elite US Market Update. Boy, this week pretty much went as expected, especially if you watched last week's recording where we talked about the fact that it appeared this was the legitimate qualifying triangle and that we had a breakout, and then when we added the Elliott Wave on, we had shown that we had the A and the B. So we just had these two segments of the flat, which gave the interpretation that the C wave would come down and test the breakout point of the triangle. And we talked about the fact that that's very common. There's several different ways that stocks, equities, ETFs, indices, securities in general break out, and one of them is they break out and take off. The other one is they break out, come back, test the breakout, and then they move higher, which appears to be what's going on now because we did satisfy the C wave of the flat. Or we get a false breakout where it looks like we're breaking out one direction and then the big move is in the opposite direction. It does not appear that that's the case here. It appears that it went just as was labeled with the Elliott wave, with the fact that we were going to have a C wave to the downside in the flat pattern, which coincided with a test of the breakout point in the triangle. Almost exactly to the point where we talked about last week. So pretty textbook stuff. Looking at the SPY to bring volume into the mix. Let's see if there's any added volume. And you can see the volume did pick up a little bit, even though we really just went through the test of the breakout. And looks like on Friday potentially started higher, but we need to break from this consolidation area here to really have a clean continuation of the breakout and show that that flat is indeed done. Something else that I also wanted to show you as far as further testing is the moving averages. We don't want to get so wrapped up in Elliott Wave that we forget to look at moving averages as well. And you can see this royal blue line on the chart here is the 50-day moving average. And look on the test. We came down, we tested the point of the breakout, we satisfied the C wave, and we came back and closed right on top of the 50-day moving average and then bounced back above it for the balance of the week. Also looking at the VIX, we broke below 15 as we had talked about, and that had been resistance for basically a couple years. It became support in February when we had the big downward break in the market, and that was support all the way up until May when we broke below it and acted as resistance. The old adage, old support becomes new resistance, and the same thing in the opposite direction. Old resistance becomes new support. We tried to break above it on the test day, and it did, but it didn't hold. There was no follow-through. The next day we were right back down to 15. We've talked about this over and over and over again, but it bears reiteration. The fact that when you have a break of anything major, a moving average, patterns, anything, you have to have not just one day, but a second day, a follow-through day or confirmation day. And we didn't get that, and that gave you the indication that the VIX was likely to come back down, and that was what also gave the market the move back to the upside. So we're back below 15. 15 is now resistance again on the VIX, with 15 being resistance and this 10 level being support. Also wanted to show you the dollar. We've been watching that. We are in this three-wave impulse pattern, as we've talked about. Big, strong impulse. There's been no correction. This little drop down here, as we showed last week, was only 23.6 on the fib ratios. That does not count in Elliott's world as a corrective segment. So this entire move here of the three wave is all an impulse move. At some point we will get a corrective move. A lot of times there is a zigzag within the three wave, but maybe we don't get one. Maybe this is just a mono wave 3, and then we come back and set up the 4 at some point in time. Interesting that the market is trying to break to the upside without a significant move back down, but boy, that's been a very powerful move in the US dollar to the upside. Taking a look at the TNX, and we really talked about this last week as well, that we gave the fact that we also had hit the 5-wave extension target, and we had this smaller zigzag pattern right here. We did have the larger zigzag pattern, which has a 32 price target, which still may very well be hit. We came down. We did not break this previous 4. That held. We came down close, but we didn't break it, so that stays in place. And then we're moving back to the upside with interest rates, and we may still satisfy that larger zigzag that we've been talking about for a while that started back here in January of this year. We'll just have to wait and see, but we did come down, consolidated, broke higher, but you consider that to be a test of the 4. It did not break it, so this overall pattern is still in place. In fact, the Wave 5 pattern itself has already satisfied it. It's done. It did its thing. It worked exactly as forecast, but we're just looking to see if the larger zigzag pattern, which is this one here, completes itself as well. But we were given reasons why we had the correction to the downside before we hit this extended target up into this area. So we'll see how that plays out over the next couple of weeks. And then also we added 2 new case studies from our searches that we create with Integrated Investor that we've talked about, directional type of positions. We have UNP, which continued its 3-wave to the upside. It was in a 3-wave last week when we introduced it, and it just continued its march higher this week in the Wave 3, so still in the Impulse Wave 3. And then on Express Scripts, as you can see with its pattern, it was just a bit of a consolidation for the entire week. So it's looking to break out of this area right in through here. And if it does, then it should be off to the races to complete its Wave 5. But there's no change in that pattern whatsoever. So still feel comfortable staying in that long position case study as we discussed last week. So going back to the markets, taking a look at where we are here. Again, on Friday, it looked like we may want to break higher. On Friday, we did have the jobs report. We cover that in these updates because it bears breaking down. The headline numbers quite often doesn't tell the entire tale. We had 223,000 private sector jobs added. There was 190,000 expected, 159,000 last month, so that number was good. Unemployment fell to 3.8, but remember that's the government's unemployment number, and if you haven't listened to these videos over the months that I've been doing them, the government's number does not count those that have been on unemployment benefits so long that they don't get them anymore, that they've fallen off the unemployment benefit list. The government just doesn't count those people as being unemployed. So their number is always lower than the real unemployment number, which is usually in the neighborhood of about twice what the government number is. So we've been up around 10%, just under that, for quite a while over the last few years before this last economic upturn occurred under the Trump administration. And it's right around just under 7%, which is still really, really good. So it's come down considerably. One of the things that the Federal Reserve likes to look at are wages. Wages increased 0.3%. 0.1% was the increase last month. And the reason they watch that is for inflation. Wage inflation is one of the key things that you look at for overall inflation. And obviously that's something that the Federal Reserve is paying close attention to for their pace of rate increases. We also had an oddity where the participation rate, if you haven't heard of that before, that's how many people that are of age and able-bodied in order to go to work. So working people or age group people that are physically able to work, actually the participation rate fell a tenth to 62.7. 170,000 people left the workforce. Well, why is that when we just had a pretty decent jobs number? And I'll give you the breakdown of the jobs number in a minute, but it goes back to what we talked about under the Obama administration, which was the health care, what they called Obamacare, or as it was really known, Obamacare is a slang name, but the Affordable Care Act, which was designed for businesses to have to give health benefits to anyone that works over 30 hours. So that created this problem that occurred throughout the Obama administration where in the jobs report, most of the jobs were part-time jobs that were being added, and they were being added in the lowest paying sectors. And so companies, rather than hiring more people and being forced to pay expensive healthcare benefits for those new full-time employees, were doing stock buybacks, paying dividends, etc. They're doing other things rather than taking that money and reinvesting it in their business as far as trying to grow it by hiring more people. Those were the statistics. Those were the numbers. I'm not being political here. That's just how the numbers wore out. Well, the Affordable Health Care Act has not been repealed, even though Trump said that he was going to. He hasn't been able to repeal that. What has come off is the mandate for individuals to have health insurance, but it hasn't come off of businesses. So businesses are, due to the fact that the economy is gaining strength, they are starting to hire back people, but maybe not as fast as they would if the Affordable Care Act wasn't still in existence. But the breakdown, and this is the important thing, and we mentioned that for years we had high rates of part-time employees being hired, not our higher paying sectors for full-time jobs, but that's getting better. Construction jobs added 25,000. Professional and business jobs added 23,000. Manufacturing added 18,000. Those are all in the higher paying sectors, which weren't getting new jobs added to them under the previous administration. Temporary workers, I think this is interesting, fell 7,800. What does that tell you? That it's likely that businesses are taking those temp workers that they had and they are hiring them. So less need for temporary workers, which that's what people were doing, is they were hiring multiple shifts of part-time people to get away from having to pay the benefits for full-time people. And now that the economy is getting better, they're starting to add those as full-time people. If we could roll back that Affordable Care Act, I think the economy would grow even faster. But, you have to look at both sides. And if the economy was growing even faster, maybe we would have greater inflation, because certainly that would drive that wage number up that the Federal Reserve is looking for, and then the Federal Reserve would be raising interest rates faster, and that would squelch the economic growth. So maybe there's a silver line in the fact that that's still a silver lining, and I meant to say, in the fact that that still exists. So with the market, we're going to keep a close eye this week. Obviously, this will be an important week to see if we continue to move to the upside here after the completion of that flat, but boy, everything was spot on this week from what we talked about last week. Hope you've had a wonderful week, and we'll be back to talk to you again next week. Take care, everybody.